So now when we look at inflation, we want to look at some of the different metrics of inflation. So when we look at CPI 2-year percent change, you can see that we're over that 5%. When you look at wages and salary, the 2-year average, we're right back to where we were, slightly below, with obviously the Fed funds rate sitting at their ever low 25 basis points. So that's where, when you look at that target rate and you look at just the CPI calculation 2-year percent change continuing to kind of grind back up, grind back higher to where we were back in 07 and 08, there's a lot of pressure behind that, and there's a lot of things that continue to move that are going to keep that driving. So when we look at headline CPI component weights, it's important to look at owner's equivalent rent and of residency is looking at reopening, but 23.5%. I mean, you're talking about something that is going much higher given where things and the percentages are, as well as rent of primary residencies. But then when you look at stay at home, food at home, new vehicles, household furnishings are starting to come down a bit. But when you look at some of these pressure points, that food, rent, owner's equivalent rent, those are the things that are going to stay sticky and are just starting to gain traction, which is why when we look at CPI going forward, it's just starting to show what we see in PPI, what we see in rent, and it's just going to be a matter of time, which is going to provide some of that stickiness and that push up as we continue to see the consumer, have to take down this increase. Now, one of the other interesting things that I saw was all money market funds total net assets are at the highest they've ever been. And back when I was working at Morgan Stanley Investment Manager, MSIM, I was in middle office operations, and we were working and helping out the money market desk, and I ended up working with them a decent amount in terms of allocations, what was coming through, because they start to creep in after 2 and then they accelerate into the close. And this is money that's coming from sweeps from custodians to the desk, and then that's invested overnight. So you can see that there is a record amount, and back in 07, 08, we had to gate what we could take because we just didn't have any place to put it. But the Fed's RRP opens up the opportunity to essentially take this and push it into just a holding pattern instead of trying to invest it in the market. And that was when we look at money market funds. So there's a thing called breaking the dollar. And breaking the dollar means that if I take $100 from your account and only return 99, that becomes a fear, and then you don't want to take all that money at once because then you create runs on banks, and that becomes a bigger issue over that time period. So then when we look at University of Michigan Sentiment Index, so there was a slight uptick in September sentiment to 71 versus 72 estimate, slightly better than August, which was 70.3. But you can still see that consumer sentiment is still at the lows that it's even below or just right at where we were for COVID. And then when you look at University of Michigan consumer expectations, that's when you see that it's back to the lows in terms of just what can I spend? What am I expecting? And you just continue to see prices going up without your wages really following, and that's putting additional pressure on things. Which is why when we look at no alleviation for buying conditions for the University of Michigan sentiment for goods, sentiment is the worst since 1980. For vehicles, worst on record, and for houses, it's the worst since 1982. So again, people are scared. They're looking at this and saying, "Look, I'm not buying this. I yield. I can't do it. I'm just going to let it settle out." And that's some of the things that we need to see, though, because with demand falling, that'll give time for supply to build back, supply chains to catch up a bit. It's just we need to see that bigger response, but that also leads to some slowdown because the consumer's not buying. You will get the inventory build, providing some of that uplift to the GDP calculation and how GDP is looked at. But on the consumer itself, you're going to see some of those headwinds start to build out over that time period. And this is when you look at expected financial situation in 5 years. You can see it's at the lowest it's been going back to 2015. And then University of Michigan real income gains during the next 5 years. You can see that, again, there's a lot of this fear about inflation and financial situation and income, where they just think that there's going to be additional pressure. And if you look in the market, they're not wrong. And that's where I think you're starting to see some of this hesitancy, which will continue to show up in the retail sales. Obviously, August was strong. Back to school, some of this normalcy, but again, this is going to be some of those pressures going forward. And then when you look at that consumer sentiment, and this is looking at something a bit different, it's something very similar back to the lows that we were in COVID. And then when you go back, you can see we're back to the lows in general. I have sentiment, expectations, present conditions, because people feel uncomfortable. And then those buying conditions for homes, vehicles, and durables. Again, just looking at durables, where things are, worst ever. Homes coming back into that level. And just as prices stay here and incomes don't come to where they should be, that's when you're going to see that hit even harder, which is when you look at current and future general activity indexes. Current has bounced a bit, but future activity is where we're starting to get hit. And again, future activity is what we keep talking about when we look at energy, gasoline, diesel. What is the future activity going to look like? And there's more and more pressure as the consumer gets more concerned. They're less likely to buy gasoline. They're less likely to go on vacation. And those are things that will, bridge and continue to build over time. And this is when you start taking all of this. So you have all of these fears, and then you look at what they're seeing. Well, Atlanta sticky CPI 12-month is starting still at that 2.6%, with more of that being pulled higher, as flexible CPI is at the highest it's been since the 70s. And again, some of that, and when you look at what happened, you had flexible go first and then sticky go with it. That's something that we expect to see, maybe not to those extremes, but you will start to see that stickiness start to come through and get pulled higher. So then when you look at U.S. import and export prices still remaining elevated, starting to come down a bit, but then, based on what we've talked about previously, that's actually going back up. You're going to see more of that as you look at export prices trying to pass on some of that cost. But then when you look at international PPI, shipping, container rates, diesel, that's again going to keep that import price well bid. And then when you look at U.S. retail sales, that was the resilience that we saw when you look at non-store retailers, still buying online, which prices are about to go up. Furniture, home furnishings, kids going back to school, general merchandise stores, core retail sales, all of that was good. But there's also that caveat of July had a big revision lower. So when you look at the revision down in July into August, that then created this overhang of August into September. And so now, given even if you normalize things, it was still a good month-over-month increase. It's not as big as it appears to be, given some of those overhangs in general. So then when we look at wholesale used vehicle prices, mixed mileage index increased 3.6% in the first 15 days of September compared to the full month of August. So again, used car prices going back up. So now, even though and this is when we start getting into stagflation and some of this pivots into some of the temporary sides, we're starting to see this kind of level off, and you're starting to see this stagflation creep where, it's going to normalize a bit, but it's not really going to come all the way back down, but stay elevated in general. So that's, then when we look at U.S. non-store retail sales still remaining strong, again, there's some of that in when we look at retail sales in general on an aggregate. Still have some of that stimulus money, some of that excess that we talked about earlier with in the banks that's still coming through, but we do see that slowing down over the and fairly rapidly as it comes back down towards the average. When you look at the retail sales trend and personal consumption, we see that coming back down to the mean. So even if it falls, it's still falling from a very elevated level. And there's a certain amount of volume versus value, because volume is coming down, but the value of it is going up because of inflation. So that's where you're going to have to see it'll take a bit more time, because there is some of that excess in savings. The top end still has some of that they can spend on that higher price, but you're starting to see some of that weight coming through and some of that overhang, as you can see here, again, coming back down to that control group and look, it's in $1 billion, because again, it's the value where the cost of it, like so far there's been a lot of pass through of price, and it's been absorbed by the consumer. And what we're seeing now is that is starting to slow, which again is going to put more pressure on retail sales in general, and again push things down and create some of that overhang. So then when you look at U.S. retail sales and U.S. retail sales ex auto, that's where, again, just going sideways for the most part. And you're just seeing some of this where it'll start to roll over as the consumer rejects some of these price increases, because eventually the consumer's like, look, as we're starting to see with consumer sentiment, University of Michigan surveys, there's starting to get a bigger slowdown in general, which will accelerate over that time period. So that's all we have for you. It's a kind of a light week, and we'll keep it a little bit faster. And now in the next segment, we're going to pivot a bit and look at Europe and go through Europe in and look at them a bit closer.